Hello and welcome to the Monday Futures Market Outlook for April 8th, 2013. This is Patrick Ceresna. As always, we start off with a chart of the US dollar index, and the US dollar has continued to try to progress higher, but each time has rejected off of that 83 and a quarter focal point that we have drawn on there. The major driver of this is the euro, and we'll be looking at that euro chart in just a moment. But even though the yen has already broken down, we are seeing a lot of the other cross currencies already stabilizing and coming off their worst levels. At some stage, some form of a correction in the US dollar that could go as deep as 81.50 on the downside is possible. But really at this stage, we believe that any selling will be short-lived. And in fact, the US dollar is probably going to be a buying opportunity on the dips. Next here, I want to take a look at the euro futures, and the euro is primarily the reason we have that outlook we do on the US dollar. This is largely because at this stage we believe that the euro situation is dire enough that it will be very unlikely that the euro can muster up strength to go back to its previous highs. And so really, while we have seen now a strong rally back towards the 131 level, and we certainly even over the next several weeks or month or more can see the euro work its way back to even that 132.50 focal point above, we believe that there will become a substantial euro distribution into any short-term strength. And so we'll be watching what the euro does into any short-term rallies. When the euro begins selling again, it is the largest currency cross against that US dollar index. And so a short-term euro top will likely line up with a US dollar index bottom. And so we'll be watching the next few weeks of counter trending to see when a turning point will emerge. Next year, I want to take a look at the 30-year Treasury bond, and this is one that we nailed right on. Everyone was so bearish bonds, telling everyone to stay out of bonds, and yet we saw that perfect bottom along a key low, and now a substantial reversal, a new trend higher in that 30-year Treasury bond. This is very crucial because this has substantial intermarket implications. What this chart isn't showing at the 30 years, that the 10-year Treasury bond has actually broken to an all-time high, which just means that yields are at all-time lows. This may be the beginning of a very big new bond move to the upside beyond what all analysts are saying out there. There certainly is a trend emerging and certainly a serious buying momentum. This will have implications for the stock market from a risk-on, risk-off perspective if a new trend begins here. But we won't be ignoring this. At some point this week, we'll probably have a throwback in the Treasury bond as such a big move. It sometimes does do a little bit of a retracing back, but something big has started here, and we're not going to go off of this bullish bond story anytime soon. It would take some substantial technical damage to revert our outlook. Next here, I want to take a look at a basket of commodities. We'll start with copper first, and copper has hit a short-term low along its 2012 lows, right around that 330 area on the downside. This is a place where technically copper should put in a bottom, but this is going to play a very much in tune with what the trend of the US dollar will be over the next 3-4 months. And we do expect there to be a copper bounce here. A rally back to 345, 350 would be very natural at this point. Just look at where the lows back in June and July occurred when a low was hit. Very quick, 20-30 cent swings back on the upside is just a normal occurrence within the process of trading. But really at this stage, whether copper can actually do something more meaningful than a bounce will depend on US dollar trend. But if that euro breakdown really starts to develop in the second half of the year and a very strong US dollar rally is underway, this may not be the bottom of copper this year, and so we're going to be looking for that retracement, but then we'll be trying to analyze the currency movement to see what's going to develop on the copper front. Next year, I want to take a look at crude oil, and crude rallied all the way back up toward its highs, never really getting properly into the 98 to 100 zone up above where we had that focal point. And really at this stage, we see crude oil continuously winding up in a tighter and tighter coil, never making higher highs or lower lows, and just trading more tighter and tighter range sideways. This is going to set up for a very big oil move move, but it really hasn't shown its hand. As far as I'm concerned, we have a slight bias to that major breakdown being to the downside of crude oil, but I certainly don't want to be too strong in that conviction until the real trend starts to emerge and show itself. Nonetheless, we'd have to see technical breaks below $92 to really start being concerned that something bigger on the downside is underway. So really at this stage, take a very neutral stance on crude oil with a slight bias that this could really engage a big move at some point in the next few months. Next year, I want to take a look at gold futures, and gold has made a substantial breakdown move last week that had to directly test that 1550 focal point we had put in place from the previous few months. Really, at this stage, this is a make it or break it moment for gold. If the gold bulls can muster up a rally back to 1600 and 1620, then in fact it would signify that this was just the last sell cycle of to retest and bang out the bottom in that bigger bottoming formation. But at the same time, if we see the little pop higher we had on Friday and follow through today fail, and the gold's quickly back down to 1550, a new sell cycle still could very much be underway, where we could see even 1500 on the downside of gold. We've been trying to be bullish on gold for a while, and it's clearly the trend has not yet changed. Really, ultimately, the only time we can really definitively be bullish gold at some stage will be when we see the trend of lower lows and lower highs end. And so really a meaningful rally back to 1600, 1620 may be the first sign that we could have an inverted head and shoulder style bottoming formation or something like that. But clearly the remainder of April will be just trying to bang out what's going on here with gold, and we're not going to be looking for a major shift yet in the next week or two. Finally, when we take a look at the S&P 500, at this juncture, we do believe that we are witnessing a topping formation. Topping formations sometimes take as many as 4 to 6 weeks. We are in the midst of that. While the jobs number sell-off that occurred last week did bring in some aggressive selling, the market will probably retrace back up and retest the highs even numerous times still throughout this process. In the bigger picture, we are long overdue for a meaningful throwback in the market. We don't believe that it necessarily has to be a crash, but rather just a correction. The only observation is that it's now starting to become a crowded idea, as many people on CNBC will commonly be now referencing that a 3 to 5% market correction here is imminent, and I sometimes don't like to be in the same camp as everyone else. And so what does that really mean? Well, it means that the market will likely either trade very range bound up here for a little bit longer until everyone gets frustrated with that theme, or two, it will be a much deeper correction that catches everyone by surprise, and we could see a full 7 to 10% correction off the high. That's something that not everyone is expecting. Now, that's just thinking a little bit outside the broader thinking, but what exactly the market has in store is uncertain. What I do know for certain, though, is that the risk reward of owning the market is very poor. The amount of upside potential versus the downside risk is completely out of balance, and there's very little value in being in the stock market at this point, in spite of what anyone else says. At this stage, we are way overweight cash. We are out of the broader markets, more or less, and looking for when the next substantial buy on dip opportunity will emerge. Just to review our keener market observations, we do believe that the risk-reward proposition of the U.S. dollar's average. If we felt that there was something deeper of a pullback, we'd already have switched that to poor because of the overhead resistance. But really, we do believe that pullbacks in the U.S. dollar will just emerge as buying opportunities, and so therefore we're going to take a very neutral stance on that risk-reward proposition. Commodities as well are very range-bound or at the bottom end of their ranges, and so while we do think that the risk reward could be good if it wasn't for the U.S. dollar. The U.S. dollar trend higher will continue to pressure commodities, and therefore we don't want to be ambitious in endorsing the overexposure to the commodity space. Bonds are the only really good risk reward proposition, but they have already moved too much in the last week for people to be rushing in today. But any throwbacks and bonds will probably emerge as a buy on dip opportunity. All stocks actually remain in an uptrend, even though global stocks have already reversed. We do still identifying the uptrend, but the risk reward of owning them is still very poor, and we're going to not deviate from that until we have a very clear and distinct corrective pattern having played out. That was your Monday Futures Market Outlook. Thank you for joining me.